Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA podcast series, and today's guest is Peter Brandt. According to Brandt, the market is a great teacher. It also delivers chastisement in large doses. Peter Brandt entered the commodity trading business in 1976 with Conti Commodity Services, a division of Continental Grain Company. From his start in the commodity industry, Peter's goal was to trade proprietary funds, but he first needed to learn the business. In 1980, Peter founded Factor Trading Company, Incorporated. In his capacity as CEO, Peter was primarily engaged in trading proprietary capital. Factor Trading also produced market research and managed the trading activities for several large institutional clients. Among Peter's institutional trading clients was Commodity Corporations of Princeton, New Jersey, at the time one of the world's largest trading houses. In 2011, John Wiley & Sons published Peter's book, Diary of a Professional Commodity Trader. The book immediately became #1 commodity and Forex trading book on Amazon. Diary was Peter's second book. His first book, Trading Commodity Futures with Classical Chart Patterns, was published in 1990. Peter's company, Factor LLC, trades proprietary funds and has achieved an audited annual average lifetime return of 41.6%. Welcome to the program, Peter.
Well, thank you, Lance. It's my pleasure to be on.
Well, tell me about your core discipline as a trader. How would you describe what you do?
I'm a pure classical chartist. My trading is influenced almost primarily by the Edwards and McGee book, 5th edition. Edwards and McGee originally wrote their book in 1948, and before that, it was based on the work of Richard W. Schabacher, who published a manuscript in about 1932, which was really the original manuscript which laid out some of the principles of classical charting. So I would say I try to be as pure a classical chartist as I can. That's my discipline. I do not use any other technical aspects in my trading operation.
So what would you consider your ideal trade setup?
My ideal trade setup is based on weekly charts. I'm not an active trader. There was a time in my trading when I was more active than I am right now, but I follow about 40 to 50 different markets. That includes Forex pairs. So I'm trading futures, I'm trading Forex markets, 40 to 50 different markets. And really, my goal is to find somewhere in the area 1 to 2 trade setups a week. They're based on weekly, and when you think about it, that's somewhere in the area of 1 to 2 trades per year per market. Looking for weekly chart patterns that are at least 12 weeks in duration. I'm not interested in smaller patterns than that. I'm looking for those weekly chart patterns to be reflected in daily charts. I am looking for patterns which I define as horizontal, not diagonal. I like chart patterns with boundary lines that go flat across the chart page. I'm not a big fan of trend lines, symmetrical triangles I will trade, although I prefer to trade patterns like head and shoulders, right angle broadening patterns, right angle triangles, pennants, patterns that for which the breakout is through a horizontal boundary line. And for me, that's the ideal setup. And again, I don't use indicators. I do use a moving average, however, and I don't use it for mechanical trading. I use it as a trend, as a proxy for trend. I like to trade patterns, the breakouts for which completely resolves the congestion within the pattern and also establishes at least a 12-week new high or new low. I look at new highs, new lows. If a market breaks out of a pattern and really doesn't establish a new 12 to 14-week higher low, I tend to be a little bit cautious with the pattern.
Well, let me put you on the spot, and let's do a hypothetical trade. You can walk me through your thought process. Let's pick on the sugar market, and let's assume that sugar has been in a horizontal pattern, trading between, let's say, 19 and 26 cents for 6 months. Is that something that would pique your interest?
Yeah, sugar has actually piqued my interest. As we're speaking here on November 8th, it's a market that I am presently short, and I'm presently short based precisely on the fact that the market is in the process of resolving a significant sideways congestion.
Okay. Excellent. So walk me through your thought process.
Yeah, sure. Well, in the case of sugar, actually, what you have is, again, I look at continuation charts. I look at markets that develop patterns, which again have a horizontal boundary line. In the case of sugar, presently looking at the continuation chart, and there are several different ways to draw continuation charts. You can flip. I don't like the ones that adjust price, that don't reflect actual prices of underlying futures contracts, but you can look at them where they roll to the next contract based on last day of the previous month, based on expiration, based on first notice date, based on which contract is most active. I look at the continuation chart, which reflects the most active contract. There, for me right now, at presently, we have a sugar market which has gone sideways for a little bit more than 5 months and has formed a descending triangle. And we are right at the point at which this market is going to have a declaration of trend, is how I would define it. And so we see the same pattern reflected in the daily chart. In the weekly chart, we have a market that has a downtrend, as I would interpret, and as a market that's right on the verge of breaking through the lower boundary line. For me, that's a great setup. I'll wait for the market on a closing basis to violate that lower boundary. I do not like using intraday stops. I enter markets based on where the closing price took place. I want to see a pattern violated on a closing basis. I have no interest in a market that just violates intraday. I do not use intraday stops. So I look at this pattern on a weekly chart. I look at its daily chart expression, and then I will roll over and actually look at at an individual contract. At the present time, is the March contracts, just to see what that's doing, because obviously I can't trade the continuation contract. I can't trade a continuation chart. I can study it, I can signal from it, but I have to execute in an individual month, and in this case that's March. And so both the March contract and the continuation chart basically right on the edge right now. And as we go through this edge on a closing price basis, I'll take a commitment in the trade.
So you are able to use extremely tight stops, but the chart patterns you're using, or the weekly charts you're using, offer very large price projections. So on the sugar trade, you have a very large price projection, but you're going to use a very tight stop. How do you accomplish that?
Well, I go by the rule, generally speaking, that when we complete a chart, that the boundary line of that chart becomes a line of demarcation, and that once a pattern is decisively completed or broken, that we really shouldn't re-enter the chart. That the chart has become an oasis in the desert, and we've left the oasis and we're now wandering elsewhere. So for me, on the continuation chart in sugar, we have a line in the sand at about 1880, and should we break through that and close somewhere down in the area of 1860, then I will turn around and I will just look at the last full day within the pattern. and I will protect against that. So, in the case of sugar presently, I'm looking at a market that I think will give me about a 500-plus point move, but my risk on the trade is about 100 points. Well, actually, it's a little less than that. It's running about 75 points, I anticipate. So it's trades that give me a very, very favorable risk-to-reward relationship. Now, risk and reward is meaningless, of course, if you don't have some idea of the probability of a trade working. But you could have an inverted risk-reward relationship with a super high probability pattern and actually work out better in terms of the statistics of the trade. So, but I believe that should this pattern complete, it has at least a 50-50 chance of running to its target.
Now, how many times will you, if it breaks out and then re-enters the chart pattern, how many times will you re-enter the trade?
Twice, and only twice. And there are some times when it'll take me for a sucker twice and give up its money on the third time, and that's the breaks. Because I think the risk of continuing to try to trade a pattern can lead to trading impulsiveness, and that is a very bad habit to get into. So I have a general rule that if a pattern completes, I'll take a trade. If it stops me out and completes again, I'll take the trade again. But I won't take it. I won't take the third strike. I'll take 2 strikes on a pattern, and that's it.
On the second entry, do you wait for it to make a new low in our example here?
No, not necessarily. I will make it. I will wait for it to recomplete the original boundary line on a closing basis. Now, in the process of the fake breakout, some of those boundary lines may be redrawn a little bit, which often is the case. But generally speaking, I'll retain the original boundary line and say this is the pattern I'm trading. Now, the reality is that I may or may not have been correct in interpreting the pattern. So, if the pattern was my imagination, of course, there's a high probability that I'll be right twice, and if I kept trading, I would have been wrong, or wrong twice. I would have been wrong the third time, fourth time, and fifth time. So, we always go by the basis of the fact that we may be interpreting a chart correctly. That's a pretty big assumption, and because sometimes these charts defy correct interpretation.
Well, tell me about your win-loss ratio then.
Well, that's something I'm working on, Lance. I mean, historically, my win-loss ratio has been in the area of, I'd say the high 30s. Mid to high 30s. That varies from year to year, month to month, week to week. I mean, it can be all over the map on shorter time periods. But I have a pretty established benchmark down in the high 30s over a long period of time. I have made some attempts to tweak the tactical portion of my trading to try to lift that win-loss ratio, bring my win ratio up into the mid to high 40s, and there's some things I've done intentionally to try to do that. But historically, it's been under 40%, which is an interesting point because what that means is that my default assumption on a trade is that the next trade I enter is going to be a loser.
Well, how do you handle the emotional side of that? Waking up.
Well, yeah, I mean, you just can't take a trade personally. A trade is just a trade. If you start taking trades personally, it's probably not a business for a person to be in. For me, risk control is the essence of trading, taking small losses is just the reality of the business, just what happens. So. You try not to take it personally. However, if you're wrong 8 straight times, sometimes it's tough putting the 9th trade on in the series. But I just have done what I've done long enough that I believe that I'll withstand the down periods. There are down periods. I've had numerous drawdowns in the area of 20% plus. I'm trying to moderate that through some things I'm doing right now. As you get older, you just can't quite take the same kind of risk in the same sort of way. But You know, there's winning times, there's losing times. There's no perfect system. But I go by the assumption that if I just keep doing what I'm doing, that I measure the performance that I have, not based on the dollars and cents of my performance, but on whether I have followed my trading plan with discipline. If I do that, I just have to trust that at the end of the day, or at the end of a longer period of time, that the market's going to give me an edge.
You've said that the worst thing a trader can do is tweak the rules of a strategy based on the result of the recent past. But when is it appropriate to adjust the rules of your strategy?
Well, yeah, again, I think, you know, if you're wrong for 5 straight times, you don't go and say, well, how would I have avoided being wrong 5 straight times, and what do I do about a trading plan that I put into place? That's a big mistake. There are times to make a change. I think every trader I know that have been successful for a long period of time would say that they have modified their trading over time. They've made little tweaks, not major tweaks. You know, I read a presentation that I gave to the MTA annual meeting back in the early 90s, and I was just absolutely shocked at on a fundamental level how little my trading has changed over time. You know, it almost read as like my plan today, with the exception of tactical considerations. But I think there's been some things in the markets, for me anyway, in the last 4 or 5 years that have resulted in some tactical changes. One thing is, you know, the move from pit trading to electronic trading, and all the 24-hour markets. I've had to deal with that and adjust that and make decisions regarding that. And I think high-frequency trading has had a big impact, at least on intraday volatility, as well as I think on just volatility itself. And that's required me to make some changes. It's actually been the factor that's led me to make the conclusion that I don't want to have intraday stops in there, because high-frequency trading operations basically make their money by playing bid and offers off of each other and knowing where the stop levels are and where the orders sit. So, you know, I've pulled those kind of orders. I want to see a market close. I'll take action after the close. I don't want to get stopped out during the session. So, you know, there are things that you can do. And again, over time, I think I've gone to a longer-term pattern. There was a time in my trading where, you know, pretty much any pattern would do. You know, I looked at shorter patterns, 1 week, 2 week, 4 week, whatever. And so I think over time I've kind of backed myself out going to a longer pattern for the purpose of probably trading less. I just can't sit and stare at a screen all day.
Well, for someone that's survived the markets for decades and done so in spectacular fashion with your annual return, what advice would you have for a new technician, a new trader, for finding their strategy, finding what works for them, surviving in the market today?
That's a great question. That's a great question, Lance. Let me just identify a few things that I think are important for traders that have just started out, whether they be chartists or numeric technicians or systematic or discretionary, whatever the case may be. I think a trader just has to know that he's properly capitalized. Coming into my markets, the futures markets, and trying to get by on a shoestring is ridiculous. You have to be able to withstand a number of losses and still have enough capital to be in the game. And you know, that's a different number for everybody, and I hate to say, throw out a number and say this is the minimum, but I guess if I had to, I'd have to say $50,000. I think the next thing is to minimize the risk on any given trading situation to somewhere in the 1% range. We've done a lot of work on probability theory and random distribution of results here internally. We have a number of models that we've developed over the years, and the reality is traders that bet 4, 5, 6% of their capital on a given trade are destined for failure. There's almost no way that they can avoid it, just by the way of random distribution of results and how they fall into place. I'd say the next thing would be that it takes 3 to 5 years to really become sufficiently knowledgeable about enough about a market to actually have a chance at consistent profitability. It just takes that long because success is based on mistakes. And it takes 3 to 5 years to make enough mistakes and to recognize the mistakes and learn from them to really have a shot at what you're doing. And then I would say that particularly for technicians, what they need to do in the first 3 years is develop some rigorous some rigor to their technical understanding. Develop a game plan. Develop a set of rules-based trading decision-making metrics. You can't walk in every day and say, well, geez, what do I think about beans today, and what do I do about S&Ps? You have to have a master game plan that you come in here and approach it like a business. So, and I think maybe the following thing is you have to have realistic expectations. I've seen people say, I'm quitting my day job because I'm going to go make 100% a year day trading the S&Ps. That's not realistic. If you look at some of the great traders over the last 20 to 30 years, you're looking at average annual rates of return in the 20s, high 20s, in some cases into the 30s and 40s. But the idea of, making her on some sort of consistent basis is a fairy tale.
Where, besides your books, where can people read more about what you have to say?
Well, I do have a blog, Lance. It's not a blog I keep up very diligently, but it's peterlbrandt.com without the www, and I do post blogs there. I used to be very active in posting blogs when the book came out at the request of John Wiley and Sons. I really don't post very much anymore, but I periodically do. And when I do, I usually will write something that I think is relative to the futures market. It may be a look at the chart patterns in a particular category of markets. It may be, commentary on risk control or general trading practices, or it may be something of interest to the general community. But that is the only way somebody has access to what I think is through the blog.
Okay. Is there anything you'd like to add before we go?
Yeah, I just thank you, Lance. I mean, a number of peers, people who I communicate with, have been involved in MTA. Wonderful organization. I mean, great diligence. It's, I think, for somebody just starting out that wants to be a technician, to go through your program is an excellent way to do it, because they can get exposed to really the best that's out there in terms of various approaches to technical analysis. Classical charting is just one, but there's so much more to technical analysis than just classical charting, and the MTA is a wonderful program for people to go through to become well-rounded technical analysts.
Excellent. Thank you for your time today, Peter.
You bet.
Today's guest has been Peter Brandt, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.